Artificial intelligence is already the biggest equity market story of the decade, and now it is rapidly becoming one of the biggest bond market stories too. Whilst equity investors assess how much growth upside AI could generate, as bond investors, our upside is capped. So believing AI will transform the world is not enough. We have to consider who is funding it, how much they're borrowing, and if the yield compensates us for the risks. For years, technology has not been a rich hunting ground for active investment-grade investors, dominated by some of the world's largest companies which have historically been cash-rich, debt-light, and highly rated. It was seen as a safe haven, trading at tight, stable spreads, but AI is changing that. The hyperscalers, Amazon, Alphabet, Microsoft, Meta, and Oracle, are racing to build data centers, buy chips, secure power, and expand cloud capacity. Capital expenditure is happening today, whilst revenues won't follow till much later. So they're increasingly reliant on debt markets to bridge the gap as spending forecasts continue to rise. The speed and scale of this transition is astonishing, with hyperscalers issuing almost $200 billion of debt this year, excluding data center financing. That could reach $250 billion by year end, rising to $400 billion in 2027. If you include the wider AI-related universe, this rises to more than $400 billion of investment-grade debt issued this year. This is transforming the investment-grade landscape. Technology has risen from 2% in the mid-2000s to around 8% of the US investment-grade index. Hyperscalers alone are rapidly approaching 5% of the US corporate investment-grade market, with an even bigger share of duration time spread, resulting in potential performance impact on the US index comparable to the big six banks. And we're already seeing this play out, with existing AI and software bonds widening materially as the market has become more saturated and obsolescence fears rise. Investor demand has weakened, with new deals having to offer larger and larger concessions. This impact extends beyond just the technology sector. Amazon is classified as a retailer, and after $90 billion of issuance year to date, makes up 35% of US investment-grade retail sector and 25% of the euro equivalent. It has dragged on the sector's performance despite most other retailers performing relatively well. Meanwhile, Alphabet and Meta, which fall under media, and data centers under real estate, show that AI risk is spanning multiple sectors. The long-term nature of AI infrastructure build-out has seen a lot of longer-dated borrowing, with an estimated average maturity of 14 years. Investors need more compensation to lend over longer timeframes, given significant uncertainty over future issuance, technological change, and investment returns. This is steepening credit curves, raising funding costs across the market. Given the sheer volume of debt required, issuers are having to diversify across markets. The US has taken most of the burden thus far, with AI-related issuance almost 25% of investment-grade supply, leaving the hyperscaler funding machine set to become increasingly global. Google and Amazon have been first movers into other currencies, but hyperscaler shares of these markets is still relatively low, with just 1.2% in euro investment grade. Meanwhile, financing is already spreading into private infrastructure debt, bank loans, and project finance structures backed by data centers. These may offer extra yield, but also added complexities and refinancing risks, without clarity on how much support the hyperscalers will actually provide. While diversifying may relieve pressure temporarily, bond investors should consider the entire pipeline rather than each deal in isolation. But this is not a story of collapsing credit quality. Most hyperscalers retain exceptional cash generation and low leverage, but balance sheet capacity and execution varies across issuers. And that is why active management matters. Passive funds will end up owning more and more of these issuers simply because they borrow more, regardless of valuations or outlook. The opportunity for us as active managers is to distinguish a great bond from a great company, choosing between issuers, currencies, maturities, and structures, and only buying on weakness when we see genuine value, resulting in limited exposure at present. AI may transform the economy, but successful fixed income investing will always come down to effective credit selection.